Now, as we pivot into the U.S., we always want to start with what is happening in the fixed income market, and we always are going to, the 10-year is kind of the bellwether for a lot of different things. And here you can see that the 10-year is pulled back a bit. It got just over, just south of 4.3%, and now it's right at about 4.07. And then when you look at the bond volatility, you can see that it's cooled off a touch, but it still remains in a fairly elevated range. And the problem is, this is what we think is that the market is starting to factor in another rate hike. Now, does it happen in September? I don't think so. I think that they might want to see how things progress, but I don't think it progresses much better, which is why we do think there's going to be a rate hike in November, and we'll talk more about that going forward. But there's a lot of staying power in the 10-year here and likely going to drift a bit higher. It's just important to see that people have been buyers of treasuries at this point, not only from Asia, but also from Europe. And a lot of that is the carry trade. Why wouldn't you take advantage of the fact that the dollar's fairly strong, other currencies are weakening? You have a healthy increase in pricing at this point. And that's where you're getting some of that bifurcation where it looks like hedge funds and others are positioning short. Some of these other guys that are more macro traders are positioned long. And that's where we kind of get this balancing act. Now, we do think that the 10-year goes higher. There is more volume. But at some point right now, you have China, which has been liquidating some of their treasuries. This isn't some, fourth dimension, let's put pressure on the U.S. This is, we need to protect the yuan, we need to protect the renminbi, so we're going to go out and we're going to go buy our currency and sell dollars to keep that FX where it is. Now, as what we think happens to the yen, and the yen weakens, and then the Fed, the BOJ is forced to cut, to raise rates and to get rid of and cut out their ceiling, that's when you could see the yen appreciate. That would then strengthen the other Asian currencies. There's also other ramifications on that we won't go into right now. But then China would be able to then go out and repurchase some of these treasuries, because some areas, for the most part, the dollar and the treasuries help in terms of creating natural cash flow into the country, providing that cash that can be used as collateral, and again, trying to support some of those currencies. But it's important when we look at, well, how does the consumer get impacted? And one of my favorite things, as I was doing the research, I've stumbled upon an old article that, they were talking, the Fed was going to launch a task force to help understand why is there such a big wealth gap in the U.S. And then this chart always comes up, and I just laugh, because it's like, well, I think this kind of sums up why. It's if you own an asset, if you own your home, if you own multiple homes, well, you made a lot of money and your wealth has increased exponentially, and wages and the gap keeps rising. Now, the biggest issue, and this is why I never quite understood the purchasing of mortgage-backed securities during COVID, because when you look at it going into 2020, I mean, I didn't see any real softness in the housing market. And then after lockdown softened a bit, there was a mass exodus from urban centers into homes. So again, not only migration, but also just inherent shifts have pushed people. So why back mortgages? I mean, you already had mortgage rates that were 4.5%. I mean, we're not looking at but yet this was the mindset. And our biggest thing, for those that go back and watch our shows, we said that it was a mistake that was going to sit and cause the Fed, way more problems than a lot of the other things that they've done. And this is just another component, because they need to smack this down. And the options are, you either smack down home prices or wages are going to go up. And the last thing they want is a wage price spiral. And if you look at some of the similarities, when you look at the 70s, there was a significant problem when you look at the underlying flows and why we see this reason where, as you went into 76, 77, the Fed thought it had gotten in front of inflation and started to cut rates. Well, they were wrong. Things reaccelerated and wages followed with it, creating a wage spiral that continued to be problematic. And this is the chart that we keep bringing up time and time again, because this is where a lot of the problems are going to continue to reside when you look at the actions. Now, posted wages are slowing more quickly than prices. So in your head, you're like, well, that's good. But at the same time, that means that the average person is getting impacted by inflation. This is a problem. When you look at posted wages are slowing more quickly than prices, it means that those prices have to be covered by something else, because there's a delta now. So that's either going to get pulled from savings, that's going to require balances on credit cards, and that creates a lot of the extra problems that we continue. But this is what the Fed wants. The Fed wants wages to slow because this will have benefits when you look at some of the shifts and some of the reductions in underlying pricing, which then will pull down some of that. But one of the things that we've been saying from the beginning is that there's been such easy money and such elevated liquidity in the market that there's a lot of things that create inflation. Inflation is not just price goes up. It's like, well, why does price go up? And it's like, okay, well, that's when you look at monetary policy and the amount of money in circulation, and when you look at how we've compounded so much liquidity and currency in the market, that takes time to come out. And then we had this massive bump of volume into the market, which then created additional weight where it has to come out. Now, two measures of activity, and I think this is interesting when you look at gross domestic income, when you look at gross domestic product. And it's interesting because we're looking at a real basis. You get an idea that GDI is a bit better at showing kind of where the GDP, or I should say the real economy, is sitting. And I think when you look at the GDP number, you'll have people that are sitting there looking around saying, well, I don't feel like we're growing at that level. But then if I showed you GDI and it's like, well, we're contracting, but slightly, and it's just been kind of a stagnating component. And I think people would, based on how you're feeling, maybe how you're seeing, how your company is running, how you're being paid, what you're hearing from upper management, if you're in upper management, what you're hearing from each other, that GDI kind of resonates. You're like, wow, that is how it looks. And I think this is an interesting backdrop. Then keeping things in real terms, you look at real disposable income, which is, again, kind of gone sideways, real disposable income trend, and how there's that bifurcation between the two. They're moving in a general sense the same direction, but one is moving in the real disposable income at a much lower level. Now, real consumer spending still remains at the elevated level. That's something that we do see slowing because the real consumer spending trend is kind of right there. But when we look at service data, and we'll talk more about that in this segment and next, you're starting to see that softness really start to creep in, and it's going to come closer to where that disposable income resides because the delta between the two are sizable, and that's going to be a bigger problem when you look at some of these shifts. So soft landing or turbulence, realistically spending came in at 0.8 in July. Inflation adjusted was 0.6. Disposable income was 0, but then inflation adjusted was negative 0.2, which is a sizable decline, and the first real one in disposable income in 13 months. Now, when you look at some of the other measures, when you're looking at wages, on a wages basis, it's already been negative. It's slightly positive, but I think we were over 2.5 years, that started to go back. But now we're looking at underlying income and the net impacts of that. Savings rates came in at 3.5%, which is down 0.8 points, which isn't sustainable because, again, you're drawing this down to keep that spread, which is why we think that you're going to get a slowdown in underlying spending. So in just a year and a half, Fed's near-term forward spread has gone from record high to record low and has not rebounded realistically as you're starting to see some GDP revisions. So the GDP when Q2 is revised to 2.1%. And when you look at U.S. GDP quarter on quarter, net exports, government spending was up. Inventories is always going to be a bit wonky, and we think inventories are going to continue to be a bit of a drain, just because there's not a huge amount of orders because we have a sizable increase in inventories. Business investment is down, but consumer spending is the biggest piece. Even though it's a small percentage here of the revisions, it has massive impacts because it's such a large part of our GDP. So as the services slow, as the consumer spending slows, that's when you get that meaningful drop to the downside, which is why when you look at aggressive Fed rate cuts have been priced out of the market for now, but expectations for Fed to ease in 2024 still around. But again, the market is just moving closer to what we were saying. We said in March of 23, we said that assumption that you see there in that yellow line, that was absurd. We said that will never happen. And now when you look at where we are in August of 24, it's a bit closer to what we've been saying. We still hold to the fact that they're going to raise rates, and then wherever they stop, it's going to stay at that level for 12 months at a minimum. And that's what we continue to see, because when you look at median personal consumption expenditure inflation, median PCE inflation, core PCE inflation, they all pivoted higher. And if you remember back when 2020 started, and then when 2021 started, everyone had these great charts of inflation is going to go up and then straight down, and everything just looked like an upside down U. And we kept saying, that is a fallacy. We've had so much liquidity pumped into the market for so long, that is impossible. And here we are. It's instead of it coming straight down, now you're getting some choppiness. Now you're seeing some of that pressure, and you're going to get to a point where it's going to hold, and you are going to have more of this inflationary pain. Now, money fund flows, safe asset demands are surging. There's still robust demand for money market funds. According to PGM Global, healthy Treasury bill spreads to average money market funds yields suggest that ongoing issuance of new supply will be funded with MMF inflows plus existing Fed reverse repo balances. So you might be saying, what does that mean? And all that means is that there's so much liquidity stuck in the system that even as you get a slowdown in Fed activity, a lot of that money is going to get pulled out of money market funds and get pulled out of repo funds. And so even though the Fed is trying to do this QT, they're fighting an uphill battle because there's a lot of liquidity that is locked in the system, which is why we've talked so much about the fact that this focus on M2 is negative, we're in dire straits, 1930s all over again. We've had so much money pumped into the system that it's sitting in these massive pockets that have to be drawn down. And that's why the Fed is stuck. So for people that are looking at this and saying, look at this, the Fed's going to have to cut rates. Oh, look at this, the Fed. No, there's so much that has to get done because they waited too long. And that's what we've been saying, is they waited too long to tighten. And for those that have been following us, that was a mantra pre-COVID, that was a mantra post-COVID, and it still holds today, which is why they're stuck. They lived on so much free money, free debt. Now's the time to pay the piper. Foreign purchases of U.S. Treasuries appears to have come largely from non-official sector accounts and from Europe. And again, that's a lot of the carry trade. That's things that are going to continue just given some of the underlying backdrops. But it's important when you look at the two measures, and we wanted to go back into this because the widening disparity between GDP and GDI indicates potential challenges for future GDP growth. And when you look at that quarter over quarter, GDI has been much weaker than GDP, in the last 3 quarters. And it takes time for that to catch up. But again, what we're saying is it's starting to catch up here as you've seen that GDI pulling down and then flatlining, GDP going up. And we see some of that rolling over. And the difference between the 3-quarter growth rate of GDP and the GDI is the highest it's ever been going back to 1950, which again is a huge problem when you look at these underlying impacts and why we're going to see that come off. Average of year-on-year percent change in real GDP and real GDI, gross domestic income, ticked up slightly in the second quarter, but 1% growth, still quite weak relative to history. GDP revised down from 2.4 to 2.1. Consumption revised up from 1.6 to 1.7, while core PCE index revised down from 3.8 to 3.7, but we actually see it going back up. But it's interesting because then it's like, well, things look great. It's like millions of Americans felt pressure to move. 8.8% of people reported that rent increase forced them to move, which means you had to move from, rent went up, so you had to move to somewhere else. About 1/3 of American adults felt pressured to change residencies in the last 6 months. That is not a good situation. If you were in a good situation, that rent increase or current rents would be just a normal expense, but it's not. And you're seeing that pain and stress ramping up with business outlook stumbling. Employees' outlook for their employers undergoes a meaningful deterioration. So when you look at it, people are also more concerned about their jobs and the health of the company they're working for, which is why when you look at the fact that they can't afford the current rent, they can't afford food, or food is getting harder and harder to afford, this becomes another bigger issue. Then when you look at financial conditions, they remain in a tight range, but they're still not very tight. And that's where when you look at Powell can sit there and say, well, I could keep taking rates up more based on this data. But he wants to get to a point that he can sit at for an extended period of time. And when you looked at Volcker went 22% was too high. He ended up coming back down to 19 and staying there. So could Powell rationally say we should be at 6.5%? I would argue yes. But I don't think he will, because he knows if he goes up to 6.5, he's going to have to cut fairly quickly. And his whole goal is to reestablish the Fed and the fact that we're not going to pivot. I mean, if you follow what he said at Jackson Hole, he was very clear. We are going to keep rates higher, and people continue to ignore it. And he has to reestablish that level of confidence that you need to listen to me because I'm not going to panic cut to save your holdings. And I think that's really important. Revision to August, University of Michigan consumer sentiment showed uptick in 1 year inflation expectations, which I think is going to continue. Same can be said on the 5 to 10 year. August Consumer Confidence Index fell to 106.1 versus the estimate of 116. Current situation fell from 153 to 144.8. Expectations fell from 88 to 80.2. So again, you're seeing some of that slowdown, but then when you start looking at the conference, so the consumer confidence is waning. JOLTS is adjusting, which is quit rate. JOLTS quit rate leads the wages. So again, you're seeing some of these slowdowns in terms of, well, how much spending can I do? I've worked through my savings. I've increased my debt. I'm not really all as confident as I was with my employer. And now you're seeing these wages and salaries continue to break. And this just puts it into a different perspective, the JOLTS private quits rates versus the private wages and salaries and how they're correlated. And typically they pull down with the other as consumer confidence contributions. Essentially all things showed some slowdowns, future business, present business, future income. So as that again weighs to the downside, that's going to pull a lot of these key components even lower. Conference Board Consumer Confidence Jobs Plentiful is below where it was prior to COVID. Same can be said with the labor differential, which is again showing why wages are slowing. Now that's a longer term good thing for inflation and good thing for the Fed. But you're getting an idea that even though the JOLTS is starting to slow and some of these other things are slowing, it's still not at the rate that they want. July PCE inflation, as we were saying, when you looked at the prior, came in at 3.3%, core 4.2%. July PC core services less housing, which for those that have been following us or for those that have followed the Fed, July PC core services less housing is actually a really important measure for the Fed. And look at that reacceleration. It went from 4.1% to 4.7%. And that was in July. And for those that have been following us, we've said that August is going to be hotter than, or accelerate faster than July. So there is a good chance that we're actually going to take out the highs that we previously saw. This is a big problem when you're looking at Fed policy, and why we continue to point to the Fed staying at the current levels that they're sitting at. Now, when we start looking at in month-on-month terms, PC inflation came in at 0.2%, core came in at 0.2%, and here you're seeing it's came down and now it's flatlining. July personal income came in at 0.2 versus the estimate of 0.3. Personal spending came in at 0.8 versus the estimate of 0.7. So again, you're starting to see, that expenditure side, the inflation pickup. Some of that income is going to continue to slow based on that wages, which is why we see some of that pain coming. Corporate profit margins edged higher in 2Q, only a slight increase to 14.3%, but they remain quite strong relative to history. U.S. corporate profits fell by 0.4% quarter on quarter, fourth consecutive contraction, but less bad than prior months' drop of 4.1%. So again, you're still seeing the ability for companies to pass through these prices. What the Fed wants is that to fail, like that companies can't keep passing through those prices, and they have to cut costs by reducing wages, reducing CapEx, and really slow down some of the economy that they're seeing. Business investment for Q2 revised down from 5.7% to 3.3%. Initial reported growth was strongest, but revised rate now strongest since fourth quarter of 22. So again, some of that adjustment. Corporate profits contracted by 6.5% year on year, accelerated to the downside from the prior quarter. So again, it's all a matter of kind of where you slice it and what data you're showing. So realistically, that's a long way of saying is it's slowing, not slowing at a rate I think the Fed wants, and also points more towards that stagnation backdrop and less towards some of the other issues that we continue to see. So that's what we have for you in this segment. In the next segment, we're going to go deeper into the real wages and spending side, because it's really important when you're looking at the largest part of the economy and how that's going to transact through the remainder of this year.